Hey, my name is Carter, and this is CoinCarter, where I share everything I know about money. Do you ever wish that your money could make you more money? Are you ever worried about keeping your money safe for the year ahead? Well, stay tuned, because in this video, we'll be discussing some key principles and strategies for successful long-term investing. And please subscribe, to see more videos like this. You need to know that this thing called long-term investing is a great way to build wealth and achieve your financial goals. First, let's define what we mean by long-term investing. Generally, we're talking about a time horizon of 5 years or more. When investing for the long term, it's important to have a clear understanding of your financial goals, and to invest in a way that aligns with those goals. For example, if you're saving for retirement, your investments should be focused on growth and income, whereas if you're saving for a down payment on a house, you may want to focus more on stability and the safety of your principal. According to a 2019 study by Bankrate, the average American household invests around 5% of their income in stocks, mutual funds, and other investments. One of the most important principles of long-term investing is diversification. Diversification means spreading your investments across different asset classes and sectors, to minimize risk and maximize returns. A well-diversified portfolio will typically include a mix of stocks, bonds, real estate, and cash. Each asset class has its own set of risks and returns, and by diversifying your investments, you can reduce the overall risk of your portfolio. A key component of investing is diversification, which is a method for distributing risk among various investments and asset classes. A diversified investment portfolio can help to minimize the potential impact of any one investment performing poorly. Here are some good ways to diversify your investment portfolio. You should always look to invest in different types of investments. Investing in different types of investments, such as mutual funds, ETFs, and individual stocks, can also help to spread risk and provide a buffer against market downturns. Invest in different asset classes. Diversify your portfolio across different asset classes, such as stocks, bonds, real estate, and commodities. Thirdly, different investment sectors help to spread risk, and act as a buffer against market downturns, by investing in various industries, such as technology, healthcare, energy, and consumer goods. Invest in different geographic regions, such as the US, Europe, Asia, and emerging markets. Additionally, you should consider rebalancing your portfolio. To make sure that your investments stay in line with your risk tolerance and investment objectives, rebalance your portfolio frequently. It's important to note that diversification does not guarantee a profit or protect against loss, and it's also not a one-time process. It's an ongoing process. Additionally, it's recommended to consult with a financial advisor before making any investment decisions. Here's a fun fact. Diversification is described as one of the only free lunches in investing. The idea is that diversification allows investors to potentially achieve the same level of returns, as a more concentrated portfolio, but with less risk. This is because when you spread your investments across a diverse range of assets, you are less likely to be affected by the poor performance of any one investment. This is why many experts recommend diversifying your portfolio, as a way to potentially maximize returns and minimize risk. When it comes to stocks, it's important to invest in companies with a strong track record of performance and a solid management team. Look for companies with a history of consistent earnings growth, strong financials, and a competitive advantage in their industry. Additionally, it's important to invest in companies that have a long-term vision and a sustainable business model. This should seem obvious, because why even bother investing in a company that doesn't even have an actual plan to stick around for the long term? Another key strategy for long-term investing is dollar cost averaging. Dollar cost averaging is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. This strategy can be useful in volatile markets, as it helps to smooth out the ups and downs of the market, and can help you to avoid the emotional reactions that can lead to poor investment decisions. Here's an example. Let's say an investor wants to invest $12,000 in a particular stock. Instead of investing the entire $12,000 in one lump sum, the investor decides to use dollar cost averaging and invest $1,000 at the end of every month for 12 months. In this example, the stock price at the end of the first month is $100 per share. The investor buys 10 shares at this price, $1,000 divided by $100 equals 10 shares. At the end of the second month, the stock price has risen to $110 per share. The investor buys 9 shares at this price, $1,000 divided by $110 equals 9.09 shares, rounded down to 9 shares. At the end of the third month, the stock price has dropped to $90 per share. The investor buys 11 shares at this price, $1,000 divided by $90 equals 11.11 shares, rounded down to 11 shares. And so on for the remaining months. In this way, the investor is able to invest the same amount of money each month, regardless of the stock price. This helps to reduce the impact of volatility on the overall purchase price of the investment, as the investor is buying more shares when the stock price is low, and fewer shares when the stock price is high. If you have any questions about this, please let me know in the comments. The next thing is to consider investing in index funds. Index funds are a type of mutual fund that tracks the performance of a specific market index, such as the S&P 500. These funds are a great way to gain exposure to a broad range of stocks, and they typically have lower expenses than actively managed funds. Additionally, index funds have been shown to outperform actively managed funds over the long term. Another strategy for long-term investors is investing in real estate. Real estate can provide a steady stream of income through rental properties and can appreciate in value over time. However, it is important to have a good understanding of the market conditions, and the property you are investing in. So to recap, investing for the long term requires a clear understanding of your financial goals, and a disciplined approach to investing. By diversifying your investments across different asset classes, investing in companies with a strong track record of performance, and implementing strategies such as dollar cost averaging, index funds, and real estate, you can increase your chances of achieving your financial goals. Remember, investing is a marathon, not a sprint, so stay patient and stay the course. That was a lot. I'm going to go nap now. If you enjoyed my video, please like and subscribe and leave a comment about any investment questions you may have that were not mentioned in this video. And thanks for watching CoinCarter. It really means a lot to me. Bye! I hope to see you again.